The Federal Reserve raised interest rates for the ninth time in a row on Wednesday, opting to continue its campaign against high inflation despite stress in the banking industry following the collapse of two regional banks. Fed policymakers voted unanimously to raise their benchmark interest rate by a quarter percentage point to just under 5%, which will make it more expensive for people seeking car loans or carrying a balance on their credit cards. Members of the Fed's rate-setting committee said additional rate hikes may be necessary to restore price stability. On average, policymakers anticipate rates climbing by another quarter percentage point by the end of this year, according to new projections that were also released on Wednesday. The committee anticipates that some additional policy firming may be appropriate, the Fed said in a statement. Some observers had urged the central bank to pause its rate hikes, at least temporarily, in order to assess the fallout from the collapse of Silicon Valley Bank and Signature Bank earlier this month. Stress in the banking system appeared to ease in recent days, however. Treasury Secretary Janet Yellen said Tuesday that large withdrawals from regional banks have stabilized, and bank stocks have rallied this week. The U.S. banking system is sound and resilient, the Fed's monetary policy statement said. Meanwhile, consumer prices continue to climb at a rapid rate. Annual inflation in February was 6%, down from 9.1% last June, but still well above the Fed's target of 2%. The central bank is particularly concerned about the rising cost of services, such as airline tickets and streaming TV subscriptions. To restore price stability, we'll need to see lower inflation in this sector, Fed Chairman Jerome Powell told a Senate panel earlier this month. The Fed is also facing scrutiny for its oversight of the two failed banks. Fed supervisors reportedly identified problems with Silicon Valley Bank's risk management practices years ago, but the problems were not corrected and the California lender had to be taken over by the U.S. government after suffering a massive bank run. We need to have humility and conduct a careful and thorough review of how we supervised and regulated this firm, said Michael Barr, the Fed's vice chairman for supervision. Barr is conducting that review and has promised a report by May 1st. He'll also testify before two congressional committees next week. Others have called for an independent probe of the Fed's role in the bank failures. Senators Elizabeth Warren, Democrat Massachusetts, and Rick Scott, Republican Florida, have also proposed replacing the Fed's internal inspector general with an outside inspector, appointed by the president.